Good morning, everybody. Hope everybody's well today. Let's get right in. 27%. Investors asked to take money out of a major private credit fund. They got about 27% of what they asked for. The other 73% stayed right where it was. And here's the part that matters. Nothing broke. The fund did exactly what its contract said it could do. And that gets right into the heart of today's story. Because a lot of headlines look like they're about markets moving. Underneath them, they're really about what somebody is actually required or not required to do. I'm Ryan Lafield, and this is Universal Asset Owners Live. Today is Thursday, August 20th, 2026. Let's get into it. Today really comes down to one question. What does the contract actually promise? We've got Treasury, private market liquidity, money moving, and some pretty big financing gaps to sort through. We'll start with Treasury, because this is where wording matters. Treasury raised a ceiling. It did not build a floor. On Wednesday, the U.S. Treasury said it will at least double the maximum size of certain scheduled liquidity buybacks. The old maximum was $2 billion per operation. The new maximum is at least $4 billion. It applies to the 10 to 20-year sector and the 20 to 30-year sector starting September 9th and running through November 4th. Now here's the trap. That does not mean Treasury promised to buy $4 billion every time. It does not mean there's a floor under the long bond. And it definitely does not mean Treasury suddenly became a crisis backstop. It raised the maximum it may buy. It is a very different sentence. The long end was already under pressure before this announcement. The 30-year yield touched its highest level since 2007 on Tuesday. By Wednesday's close, it was 9 basis points lower. But some of that move happened before Treasury spoke, so we cannot hand this whole rally to this policy change. The cleaner read is that investors liked the prospect of larger future operations after a sharp sell-off. And that brings us to the bigger question underneath all this. When we say something is liquid, what exactly are we talking about? Because that word sounds simple. It really isn't. There are 3 different things hiding inside it. Market liquidity asks whether the asset itself can trade. Funding liquidity asks whether the owner can meet the cash demands coming at them. And contractual liquidity asks whether the investment vehicle actually owes you your money back right now and under what limits. Those 3 things often move together, but they don't have to. And today, they didn't. That is exactly what brings us to Blue Owl. Final second quarter filings from 2 of its vehicles give us a very clean example of contractual liquidity in action. Investors asked to take money out. The funds gave them back only part of what they requested. That sounds alarming if you stop there. But the contract matters. The tender limits were disclosed in advance, and the funds operated inside those limits. So this wasn't the structure failing. This was the structure doing exactly what it said it would do. And that's where this story gets interesting. Start with the credit fund. Repurchase requests came in at nearly 19% of shares, about $3.6 billion. The fund brought back 5% of shares outstanding, just under $1 billion. That filled about 27% of what investors had tendered. The technology fund was even tighter. Requests came in at just over 38% of shares. Again, the fund bought back 5% of shares outstanding. That filled only about 13% of what investors asked for. So the demand for liquidity was much bigger than the liquidity the contracts promised. And that is the point. All right, let's see how the money moved. First, Alphabet raised 5.5 billion Australian dollars in its first Australian dollar bond deal. Demand was strong. Orders topped 18 billion Australian dollars across 4 maturities. For local investors, that means access to long-dated Alphabet credit without having to take the currency risk of buying a US dollar bond. But there's one thing we cannot say here. Reuters did not report who bought the bonds or what Alphabet plans to do with the money. So we're not turning this into an AI funding story without evidence. Next, Clearco. The headline number here is $100 million. That's the facility it secured from Macquarie's New York team. You may also see $900 million floating around. That is Clearco's own projection of how much customer funding it expects to provide over 2 years. It is not Macquarie's commitment. And finally, Ontario Teachers. It returned 9.5% for the first half of the year with net assets of about 303 billion Canadian dollars. One timing detail matters here. Its 111% funded status is from January 1st valuation. So the strong first half supported the balance sheet. It did not create that funded ratio. 3 stories, 3 very different numbers, and 3 good examples of why the headline number is rarely the whole story. Let's move to the risk side of the board today. The risk radar takes us to land restoration, and the numbers are enormous. The UN Desertification Convention says the world needs about $355 billion a year for land restoration. Right now, it's getting about $77 billion. That leaves a financing gap of roughly $278 billion every year through 2030. And here's where I think it gets interesting. You look at a gap that large, and the instinct is to say, well, that sounds like an investment opportunity. Maybe. But a financing need and an investable opportunity are not the same thing. Restored watersheds, soil carbon, drought resilience, and grazing productivity can all create value. The problem is figuring out who actually pays for that value. A lot of the benefit is an avoided loss, and nobody automatically writes you a check for an avoided loss. So before an allocator looks at a number like $278 billion and sees a new asset class, there are some very basic questions. Who owns the land and the consent rights? Who pays for the outcome? How do you verify that the improvement lasts? And who takes the loss if it doesn't? That is the risk. The need is obvious. The investment structure isn't. And we'll come back to that idea on the back page because it fits today's allocation nobody made almost perfectly. And there's another risk story moving underneath all of this: power. 3 governments are moving in the same general direction on data centers, but they're doing 3 very different things. Pennsylvania first. An executive order signed this week removed data center projects from the state's permit fast track. That is not a ban. It means the approval path gets tougher, especially for larger projects. PJM is different. It has proposed new conditions for large loads above 50 megawatts. If a project has not brought enough new capacity with it by mid-2027, its service could potentially be interrupted during grid stress. But that is still a proposal. The federal regulator has not approved that. And then there's Ontario. Ontario has opened a consultation on a separate electricity class for new data centers. Again, a consultation. No final class, no final threshold, no final rate. So the direction is clear. The assumption that a data center can simply show up, connect to the grid, and get power is getting harder to make. But the legal stage matters. An executive order, a federal filing, and a consultation are not the same thing. And if you hold data center exposure, that distinction matters a lot. All right, one thing to do before we wrap. Take one page of your cash calendar this week and rebuild it from the actual legal terms, not the label. Look at the notice periods, the tender caps, the queues, the proration rules. What does the document actually say you can get back and when? Because that's really the lesson running through today's show. The headline might say liquid. The contract gets the final vote. And while you're at it, if a private credit default rate comes into committee, ask one more question. What exactly is being measured? the universe, the look-back period, how amendments are treated, and what sits in the denominator. Two numbers can disagree and still both be right. They may simply be measuring different things. Here's today's boardroom question. Where are you assuming liquidity that the contract never actually promised? Could be a tender window, a notice period, a grid connection, a curtailment clause. Whatever the asset is, go back to the document. Because today's stories all point to the same thing. The label tells you what you bought. The contract tells you what you can actually do. All right, today's allocation nobody made. Land restoration again. About $355 billion, as mentioned, a year is needed. $77 billion is currently flowing. That leaves a massive gap, but there's still no single clean instrument, no obvious payer, and no easy way to price performance. So the need is obvious. The allocation still isn't. Time for the back page today. Here we go. I love these. Honestly, that may be the cleanest summary of the whole show. Market liquidity and the other kind. All right, that's a day. That's Thursday's briefing. Treasury raised the ceiling, the contract set the limits, and the grid is starting to write itself into the investment case. That's it. I'm Ryan Lafield. Thanks for tuning in. If you want the full brief behind this, it's free before the open at universalassetowners.com. And it's already being read at desks directing more than $50 trillion in permanent capital. So come join us. Wherever in the world you are, have a great rest of your day. Keep looking for the signals. See you tomorrow.